Hello, everybody. Welcome to another edition of Coffee with Kirk. This is the first one we've had since the election, pretty much, at least where we can kind of take a look at it. So really today, that's what we're going to talk about is just what was the immediate aftermath in the financial world after Trump won, and what's kind of taken place really the last week or so. It was almost like there was a instant reaction, and now we're digesting things, and markets are kind of repositioning. And my approach is always, the initial reaction could be the right one longer term, but you still kind of have to deal with what's the reality on the ground. And anytime you have a president or a change at corporate leadership, anything like that, it takes time for any of those changes to take effect. So whether you like Trump or hate Trump, it's going to take a little bit of time. You turn in that aircraft carrier you can't just come full right rudder. You're gonna roll the ship. So it's going to take a little time before things really pan out, and you just never know what might happen. So, what I'm looking at is what's the reality in the economy and everything like that, because that aircraft carrier is going one way, and Trump probably wants to come in and change it, but it's going to be a pretty slow moving process. So we'll just kind of take a look at all of that. So like I usually do, we'll jump into some slides. I love those slides. So I thought one thing that was kind of funny is I saw this on Twitter right after. Really, I think the instant reaction to the Trump election is I say it was the junk did really well. Junk and stuff that's already heavily overvalued really shot up. So this was just a guy throwing away his book by Benjamin Graham, The Intelligent Investor. It's kind of the Bible of value investing. And, you always hear how Benjamin Graham was a mentor to Warren Buffett. And, he's basically throwing that away. He's saying Dogecoin is up 170% in last month. So, crypto really just jumped with Trump. We'll start right there. I mean, crypto really popped. And I showed this. This is the 6-month chart of Bitcoin. And you really see it's kind of been in a zone between 60,000 and 70,000 for a few months now. And then soon as the day Trump was elected, the thing just took off and really hasn't looked back since. It's 92,000. Part of that is the fact that Trump has publicly said that he's going to be more open to Bitcoin and crypto. He actually sort of wooed that audience, the people they're focused on it. So, part of it could just be legit longer term trend that, the SEC is going to back off a little bit on crypto. But we'll see. We'll see how it goes. Some people try to argue, well, it's an inflation trade, but the thing about Bitcoin is when I was talking about it a couple of years ago to clients, I was sort of focused on it being almost like a reserve currency, a little bit of a pseudo gold, kind of a currency replacement, but it's just so volatile. It's nowhere near being that right now. So it's purely a speculative asset at this point. Whether it ever really gets to the point where it becomes a reserve asset or a currency, I don't know. I don't know if it's going to happen or not. But the Bitcoin folks are hoping that with the Trump election, that will happen. But it wasn't just Bitcoin. Pretty much every crypto just popped as soon as that happened. Now, crypto, again, it's how you look at it. So many people say it has absolutely zero true intrinsic value. while others say it's the future, but it's definitely a speculative asset, that's for sure. The other thing that really popped right away was the mega cap stocks. So, we talked about this, the Magnificent Seven. A lot of those stocks really jumped. NVIDIA, Tesla. Here's a chart of Tesla, but you can see circled in green. It really popped as soon as Trump went out. A lot of people could say that is because Elon Musk was so involved with the Trump campaign, kind of expecting some paybacks for what he did for Trump. But it wasn't just that. It was NVIDIA, another one that has, kind of been just moving way beyond fundamentals, in my opinion. But it popped as well. This chart just shows you both NVIDIA and the Russell 2000, which are small company stocks. So if you see there in the chart, November 4th, small cap stocks in the blue, NVIDIA in the gold, both of them just popped big time, big jump. Small caps were up in 2 days over 8%. NVIDIA was up probably, a little bit more than 8, about 9%. But both of them have since started to fade back, especially small caps are almost back to where they were. But, a lot of those things were going. Another one, kind of the junk really jumped, the more speculative stuff. So the most shorted stocks took a big jump upon the election. And so shorting a stock means you are pessimistic on its future. You think it's going to go down. So companies that have 50 to 60% of their shares outstanding have been borrowed to be shorted. So those stocks really jumped. So, on the stock side, on the crypto side, it was the most speculative assets that took off. So that could be the market saying that we expect better times for the economy and stock market in general. That's the instant reaction that we got, but we'll have to see how that goes. Again, instant reaction, and then reality kind of sets back in. Now, Treasury took the opposite approach here. As soon as the election, they've been kind of going up in yields for a while now. The yields have been rising, but they really spiked up once Trump got elected. So it could be that, treasuries expect growth, just like maybe some of the more speculative stocks do. So we could say, all right, the market thinks Trump's going to be very good for the economy. It could also be inflation. Anytime you look at bonds, you're looking at kind of future growth perspectives. You're also looking at inflation. It basically tells both of those stories. You don't really know which one it's actually telling until later down the road, but certainly treasuries jumped up, and it could be the inflation component, because what this is it's called the inflation break-even point. So it's trying to say what's the level of interest rate you need on bonds to make up for the projected inflation rate. So really, since late August, this has been going up. So inflation has been expected in the bond market for a couple months now, but it really took kind of a parabolic jump when Trump got elected. So right now it's saying about 2.59% of your bond yield should be there strictly to compensate an investor for the risk of inflation. So that's definitely been climbing. So, that overall, I think the bond market's expecting some reoccurrence of inflation because this has been going on since August, but it definitely took a jump when Trump came in. Initially, oil also pumped up. Trump has talked about drill, baby, drill, and certainly going to be a lot more conducive to energy than the Biden administration has been, at least internally. So that initially took a jump up. We'll talk more about that. Gold got just hammered right from the day of the election. So tons of gold, the price of gold just pulled back substantially. Now, I actually have been waiting for some sort of pullback in gold. It's just been on that train heading north the whole time, just going up, up, up with really no pullbacks, no corrections whatsoever. So even from just a technical standpoint, I think it's a good thing, and it could just be a technical move. Gold needed to have some sort of breather for a little bit. But we'll see how it goes. The 1 month, it's down about 4%. That's still not a very big correction, but you needed something just to kind of cool it off. But the reason gold really sort of dumped a bit was the dollar jumped substantially upon the election. You can kind of look at this chart, a little hard to see, but at the very bottom, you can see the dates. So you get that November 5th, and you can see the next day, the dollar appreciated rapidly. So that's definitely investors saying that they expect, Trump to be a lot more U.S. focused. Part of this could be, tariff based, thinking that there's going to be, tariffs in the U.S. so that money will kind of move back here. Capital will, as they maybe build new plants and new manufacturing. So it could be part of that. But gold and the dollar have typically had an inverse relationship, since gold is seen as sort of a proxy for currency debasement. If gold's going up, usually the dollar's going down. Now, it hasn't been that way for the past few months, but with this decisive of a move in the dollar, it certainly brought back that historical relationship with gold. Utilities actually did pretty well. So again, this could be an inflationary trade. Again, you're going to have to wait to see what happened, but from November 5th on, utilities have done well. Now, some positions that we hold, some individual positions that had interesting moves, General Mills. So we have a small little bit in General Mills. It was a consumer staple I bought. And you can see as soon as the election happened, General Mills definitely dumped. And that could be the RFK component. So General Mills obviously makes a ton of processed food. And that processed food is usually comprised of numerous inputs for each product. Cornflakes here have 25 different ingredients, whereas cornflakes in Italy have like 4. So, this could be just a move that they're like, processed food's going to have some trouble here. Now, incidentally, Kroger, so the shopping stores, everything like that, Kroger did very well. So you're like, why would that be? Well, that's more of a Kamala didn't win play. She was talking about price controls on food, all that kind of stuff. And, Kroger doesn't have a big profit margin. You're talking 2 to 3% profit margin. So if they were going to start to put in some sort of price controls, it might have been tough. But soon as Trump won and she lost, Kroger took off. It's pulled back a little bit since then. Again, initial reactions are a little bit different than the reality on the ground, but that definitely did pretty well. Another little position we've had, sort of defensive, didn't do well from when Trump got in, healthcare. So here again, this is probably more of an RFK play than necessarily just a Trump play, but most of the healthcare ETF that got hammered was the pharmaceuticals. So this is Pfizer. And you can see Pfizer really took it on the chin, and it took it hard once he was elected, but it's been going down for a while, mostly because the markets thought Trump was going to win. And then there's going to be some sort of change in the operations of the pharmaceutical industry. Now, it depends on where you stand on all that. I'm all for basically kind of taking away a little bit of the power of the pharmaceutical companies. You see all these ads on TV, ask your doctor about the purple pill. And here's the thing, they're not advertising on all these different channels so that you'll go ask your doctor about the purple pill. They're doing it so that they could have some control over the media. So that if the media runs stories that are negative about the pharmaceutical industry, they can say, well, guess what? We're going to pull 30% of your revenue if you don't shut the hell up. So all that could change, and that certainly manifests itself initially, and it's continued on actually since the election. It wasn't just an initial Trump reaction; it was something that's ongoing. Another interesting thing is when Trump got elected, international holdings really took it on the chin. So that could be the fact that people think that the growth will happen here in America with Trump, pro-America policy. Could be the tariffs. So tariffs, when you assign tariffs to foreign companies, and we are obviously the biggest market for goods and services in the world, it could excuse me, that could be affecting international equities, international bonds, everything like that. So this is a holding that we have, the Franklin International Core Dividend. I've always liked it's a very heavy value play, but over the past month, it's down about 5%. It's broken through my trading measures, so we'll probably be liquidating that next week. I still like international on a relative basis valuations. It's much cheaper than the U.S. market. Like this holding in particular, because it is yielding a little over 5%, so you get 5% dividend yield. But it's pretty clear right now the markets are saying that they expect that either the tariffs or the pro-U.S. policy of Trump is going to have an impact on international markets. Natural gas also saw a nice little jump upon Trump's election. So President Biden actually had put a restriction on natural gas leading up to the election, where we weren't allowing our abundant resources of natural gas to be shipped out to other countries. He was requiring it to remain in the U.S. And so basically taking away a lot of the demand for our natural gas products drove the price of natural gas down to around $2 per million BTU, which is the measurement, the MMBTU. So it really kept things cheaper on your utility bills. Some people say it was an election move to bring down prices, and I think it was. But now with Trump coming in, pro-energy policies, and also the fact that he's going to let this stuff be shipped around, so now you're going to have more demand for our natural gas. So the price has jumped up from around the $2.2 per million BTU to roughly close to $3 right now. So that's a pretty big move for natural gas. So those were some of the key markets and the initial reactions for the election of President Trump. But again, this is the economy is, going back to my example of driving a aircraft carrier. You might change captains of the ship, but you're still kind of involved in whatever the conditions of the sea are. You could relieve somebody of being the officer of the deck that's driving the ship, but if conditions are bad, if storms are on the front, doesn't matter who takes over, even if it's a better captain in many people's eyes, more talented captain, and if you have storms approaching, there's going to be issues with it. So I think what we saw was an initial jump of where people think it's going, but we've seen things start to fade, and the conditions on the ground, the storm clouds, whatever you want to say, are back into play. And in one of them that we see a little bit, it could be maybe inflation is starting to pick back up. Ever since the Federal Reserve cut their interest rate, the markets have been pricing in more inflation. As I showed you in a graph before, the break even for the inflation rate on bonds has jumped up to over 2.5%. And we're starting to see that, just recently this week, the producer price index. So this is sort of the consumer price index, the inflation measurement for producers. And that has once again gone above 3% on a year-over-year basis. So, if the people making our goods are seeing inflation. They're going to pass that along to us. So we might be starting to see that. And again, that could be manifesting itself in the bonds. So since the Fed has cut rates in September, the 10-year Treasury, as well as all longer dated Treasuries, didn't have the effect that people thought where they go down with the Fed cutting. They've actually gone up. So again, what that can be is two different things. It could be the market, the bond market saying, hey, we see a lot of growth coming. Absolutely could be that. But it also could be that they see inflation coming back up. And the fact that the break-even rate is back to 2.5%, that kind of tells me that maybe they expect more inflation than what is generally talked about. And you can see a lot of people thought with the Fed cutting rates, it was going to help on the 30-year mortgages, and it hasn't. So that's still going to be a very big headwind for the economy. You know, you're looking at 7% for the 30-year right now. So it's still pretty high. That's definitely going to impact the mortgage markets. But another thing I think that the bonds are talking about here is and we've addressed this in the past, it's just the amount of government deficit. This is just the chart for the U.S. deficit just for the month of October, you know, going back to 2010. And you can kind of see this was the second worst deficit month, with the exception of when COVID hit, and they had just a massive amount of stimulus back then in October of 2020. So, you know, we're looking at routine $2 trillion deficits right now that are only going to get worse as more boomers jump onto Medicare and Social Security. So, you know, the big thing is going to be, you know, how's this going to impact inflation in the bonds? Now, hopefully, in my mind, hopefully you may see it differently, but I do think we need to start looking at ways to cut the budget and do it pretty rapidly. People think I'm nuts, but I say, look, we could cut the federal government by 50%, and it wouldn't impact you or any of U.S. taxpayers in any way, unless you work for the federal government or have a contract where you're basically serving the federal government, which is a small percentage of the population. Everybody else probably wouldn't notice it. And even in the military, I talk about this. Maybe I'll do a deeper dive on it. But, you know, we're spending way too much, $800 billion. And a lot of people say, oh, no, we need to strengthen our military. I'm like, look, the vast majority of our military expenses, I mean, it was $4 trillion budget when Trump was in office the first time, and now it's $8 trillion. So we didn't increase our capacity by $4 trillion since he was in office. It's been waste, honestly. And to give you some perspective on it, you know, during World War II, we had 7.5 million men fighting World War II. So 7.5 million people were active duty. And we had, I think, 24 four-star flag officers, so admirals and generals. We've got, 1.5 million active duty right now, and we still have 24 four-star flag officers. So clearly some, you know, fluff at the top right there. And I think I'd read one time how we had 7 people supporting each person fighting during World War II. And I don't know the exact number right now, but I think that number is like 24 to 1. So for every operational ready military member we have today, somebody who would be fighting on the front lines, we've got 24 people on the back end. So clearly there's ways to cut this thing without affecting our operational readiness in any fashion. And I hope they start to find that. And that applies to basically every government organization in my mind. So anyway, I'll get off my soapbox on that one. But if you know me for a long time, I've complained about government spending forever. But along with having deficits, things like that. We still have some other headwinds, some other storm clouds on the front I've been talking about. The big one is the jobs market. It's definitely weakening. And, just recently we're starting to see that temporary jobs, which is a leading indicator for the job market. We had a lower demand of 240,000 temporary jobs. And temp jobs are the first ones to go. If you're hiring somebody from a temp agency, you're not going to lay off one of your full-time or even part-time W-2 employees in order to keep a temp. If a temp's that good, you're going to try to make them a full-time employee. What you're going to do is you're just going to get rid of the temp agencies. And that's what we're seeing right now. This is a month-to-month of the basically establishment survey for payrolls. Now, October was a really odd month. There was only 12,000 jobs created. And people talked about the hurricanes. We need to see some more data, like the next 2 months when they revise these, to really see what was going on. But the thing is, they've been revising these payrolls down for a while. And, it was just 3 months ago that they took their annual revisions and took 818,000 jobs that they said were created that actually weren't. So it's definitely, job market's definitely slowing down here. Now, this is the unemployment rate, and it's still, really low relative to, say, 2008, when we got to 9% inflation rate. And then, of course, COVID, that anomaly really took it up near 15%, very temporarily. But the thing, it's the trend, right? The trend is the one you have to watch. And we're certainly seeing some movement up in the unemployment rate. So there's definitely some headwinds here that, no matter how much you believe in the Trump agenda, it takes some time to really start to rectify some of these. And I think we're starting to see maybe the markets are starting to price in some of they're coming back off the glow of the Trump election and looking at the reality. So this is just the commodity index. Initially, after Trump got in, had a nice bounce, but it's been fading back. So when commodities are fading back, that's the market saying that, we just don't think demand is all there. I mentioned oil jumped when Trump got elected, went up over $72 a barrel, but since then, definitely been fading, and we're now down below 67 a barrel. So oil, again, is the lifeblood of the economy. The more activity we have going on, the more you're going to see that demand for oil. And even OPEC is saying that for the next couple of years, they're just not seeing, the oil demand that they've been anticipating. So they're seeing lower demand for it for the rest of this year and then 2025. And part of it, I think it's not getting any press right now, but China's definitely in trouble. So China's use of oil is starting to fade. And of course, if China, one of the biggest manufacturing or the biggest manufacturing country in the world, their demand should always be heading, up and to the right, but it's not. So it's starting to fade quite a bit here too. And what's interesting, this guy I follow on Twitter, Michael Cow, and he identifies, he's been talking for a while, like he's responding to Bloomberg that said, China is looking to cut taxes for home purchases to try to get the home market going. And he's like, look, there's already 90 million unoccupied housing units with another 120 million being built. Said it's just not going to happen. So it gets to kind of a bigger issue. You are starting to see money leave China. So more investment firms are dropping China than they ever have. So the amount of money coming into China is definitely drying up. But it all comes back to their debt is just getting to be uncontrollable levels. And especially when so much of it, like this sort of purple, the non-financial corporates, that's a lot of housing. And their housing has been something that's been an enormous tailwind for them for so long. And now it's starting to be a serious headwind. And then, if they start to see some manufacturing leave, that could have a big impact on them. So they're highly leveraged and starting to slow down on the growth. And that's just not a good thing for an economy like China. And it's nowhere near as developed as the United States, despite having lots of manufacturing. They don't have a lot of services or other areas that can sort of help them weather beyond the manufacturing and home building. So if either of those start to take a nosedive, they don't have a whole lot of security blankets at that point. The other thing I've been harping here, and it got even worse from when Trump got elected, just the U.S. stock market's so priced for perfection, and it just makes it awfully difficult. If anything goes wrong, U.S. stocks are definitely going to struggle. This is just a chart showing you the equity risk premium. So what is the anticipated return you're going to get for investing in stocks versus bonds? And what it looks at is the 12-month forward earnings yield on the S&P 500. Now, I talk a lot about the price to earnings of the market. The earning yield is just the opposite. It's the earnings divided by price. So it's just a little bit different way to look at it, but it's saying, based on the earnings yield and what you could get right now in a 10-year Treasury note, there's really no value to taking the risk of stocks compared to a 10-year Treasury. So it's not expecting right now. It's at absolutely zero. It's saying, over the next few years, if you bought a 10-year Treasury, you should probably get the same return as you would get from the stock market based on the equity risk premium. It doesn't mean that's going to happen, but that's just if this one indicator lives up to what it has traditionally shown. I mean, there's some periods, once we got to 2009, there was an 8% equity risk premium. So you were technically getting paid 8% to take the risk of not going in the 10-year Treasury and going into the stock market. Even at the end of the 2002, the tech bubble bursting, you were looking at probably 3.5% premium over investing in treasuries. So that's definitely, you can see that's definitely been coming down pretty rapidly here since COVID. And, you have to just look at, is it worth taking the risk of that stock market? And, the U.S. stock market is measured by the S&P 500 relative to the entire world gross domestic product. It's 50% of it. So it's saying the 500 largest companies in the U.S. are now worth 50% of the entire world's economic activity. And you can see we've blown way past the last peak we had back at the tech bubble in 99, when we were just shy of 40%. So right now, we're sitting there hitting 50%. It just shows you a pretty richly valued market. Doesn't tell you anything about the short term. This chart's very difficult to read. I apologize. I was trying to find it somewhere else that might have been better, so it's tough. But basically, looking at 20 key metrics that we look at, it's just saying, look, it's U.S. is awfully expensive. 19 of the 20. If you need to, you can watch a replay and zoom in on this a little bit, and you can kind of, for each of these, like trailing price to earnings. Currently it's 25.4. The average is 14.9. So, that's 70% higher than the average. And then it gets into all kinds of different items that you can look at as far as cash flows, comparing it to, dividend yields, comparing it to oil, price of gold, everything like that, comparing it to the gross domestic product. It's a pretty expensive market. So again, initial reaction was Trump's coming in, things will be good, and it very well could be. But there's a lot of, when you're priced like this for perfection, it takes a lot of growth to drive that stock market even higher. And of course, I always talk about NVIDIA. I get all kinds of questions from clients about investing in NVIDIA. And if you think Bitcoin's expensive, NVIDIA is right there with it. Right now, NVIDIA's market cap is worth more than 5 of the G7 countries' entire markets, every company in their stock markets. So if you took Canada, the UK, France, Germany, and Italy, right now, NVIDIA is worth more than all of those. So, that one company, they make a great product. They make a product that's in demand for AI, but just like the internet companies in 2000, the internet certainly was the future, but valuations do matter. And I don't know what's going to spark it for the markets to finally look at valuations and demand that. They get compensated for the risk they're taking. But if something happens, companies like NVIDIA are, they're in some jeopardy here due to trading at 40 times sales and 120 times earnings, that kind of stuff. So, so what am I looking at? I'm not making any huge moves, but something that's definitely jumped out. I showed you the chart for natural gas. There's absolutely going to be some potential for companies that deal with natural gas, whether it's shipping it or pulling it out of the ground. A couple companies we've invested in the past, Antero Resources and Range Resources Corporation, both of those are focused in the Permian Basin and on natural gas. So we'll probably be adding some back in that. It was pretty, these things were highly undervalued. Both of them have, I think Range Resources has single-digit price to earnings and over 2% dividend yield. And then Antero is like a 14 price to earnings, I think. I might be mixing those up. So these things are pretty cheap. And then with the fact that we're going to open up our natural gas markets, especially to Europe, but around the world, that's going to create demand for it. So these companies should be able to benefit from that. Energy companies in overall, even though the price of oil has started to come back down below 67 a barrel, energy companies are still doing pretty well. So we might dabble back into that, sort of move from healthcare over to energy a little bit. Energy is the one sector that is still really cheap relative to its historical norms. And, this year it struggled, but it's starting to catch its legs a little bit here. And we'll see, even if the price of oil could kind of just stabilize where it's at, you kind of expect these companies to start to do a little bit better, just because it will be a more favorable environment for energy over the next, 4 years probably. But those are probably some of the areas I'd look at, but nothing too crazy. I'm definitely not going to go into any of the more volatile stocks right now that everybody's talking about, moving away a little bit from international, at least right now, even though it offers more compelling valuations. So that's really sort of what we're looking at. And of course, as always, I throw down here the lawyers say hi kind of thing. So if you want to read our disclaimer, please pause this and you can go through it word by word. Okay, so I'm looking in here. Not a lot of questions. Okay. But again, if you can give me questions, that's sort of what I base all this on. I've been getting questions on Bitcoin, on NVIDIA, on what's going to happen with Trump be elected. What areas do I like? Again, I kind of like the natural resource a little bit. I do sort of think it's probably a good time to add a little bit more, gold and silver. If you wanted to do something like that, I'll probably be doing it. Been waiting for pullbacks for that for quite a while. Here's a question. What's your thought? So central bank digital currency. So Bitcoin, of course, has been talked about as being a currency. So central banks around the world are looking to create a digital currency. And I think that would be the absolute worst thing in the world. For a couple of reasons. One, at that point, that's what they have in China, and they have a social control system there that if you're doing something that they don't like, they can basically shut you off your money. There's nothing you could do. So there's definitely some risk from a freedom standpoint on it. And I always look at that. But even from a purely economic standpoint, once you have that in place, then there's really absolutely no reason for them not to print money. So I think it would ultimately lead to a much more inflationary environment for people, because the Federal Reserve would just print. They basically be bypassing banks, and they would become the direct currency. So yeah, if that starts to gain traction at any time in this country, I'm going to do everything I can, put any political pressure I have to do to try to derail that. What do I think about the proposed tariffs on China? So you have to look down the road on that one and take a step back and look at what's been going on for years. So my personal opinion, I might come from a different perspective. I grew up in Flint, Michigan, which was absolutely, an industrial manufacturing town. It was a mini Detroit. And, I witnessed kind of the decline. So as a kid in the 70s, I was there when Flint was a great place to be with the highest median income. But then you started to see GM and Ford became sort of less competitive relative to Japanese manufacturers as they really got their legs. But then you also started to see late 80s, 90s, the outsourcing, basically tearing down the situation where companies could go overseas. And we just saw millions of jobs go. And towns like Flint, very strong middle class, really got gutted. So if you look at it from a perspective that what they'll do is they'll put up some tariffs and try to motivate companies to bring manufacturing back here, or even to other countries where we have agreements where the tariffs won't necessarily be there. So it could re-industrialize us. So it's not only good for some of the folks in the middle class that maybe don't get white collar jobs, it's also kind of needed for security. Right now, if we were to go to any kind of hot or cold war with China, they could shut us down. I mean, completely. They produce everything from medicines to things that keep our electrical grid going. I mean, just basic stuff that we need would all be gone. They could shut it down. And so we need to have the ability at least to not have to depend on a 6,000-mile supply chain, and then one that could be with a potential enemy, or definitely somebody who could be a threat if they wanted to. So I think from those aspects, it's good. The other thing to remember is we have very low tariffs right now on all countries. Most of the countries we deal with have substantially higher tariffs on us than we have on them. A lot of the goods that we'd want to ship into China, they've got 70% tariffs on our products, but we keep a 10% tariff on theirs. So you have to say, is that fair trade? Should we say, all right, if you're going to slap a 70% tariff on our automobiles trying to come into your country, shouldn't we have 70% tariffs on them? And what you'd find if you start to do that is they'll bring down their tariffs, and then hopefully we'd bring down ours. We start to find a sweet spot for both countries. It's same with Europe too. There's definitely a one-way street there that they've got higher tariffs than us than we have on them. So it's a lot easier, a lot cheaper to get your French wines and your German auto manufacturer, your German cars, things along those lines. And if we raised our tariffs on them, those products are going to initially become more expensive. So in the short term, it would be inflationary to some degree. But there's one benefit, that the dollar has gotten stronger since Trump's gotten in. And if there were more tariffs, I would expect the dollar to continue to get stronger. And if the dollar's stronger, that actually helps Americans on purchasing products. So it makes it cheaper to buy stuff. And remember, 40% of the United States population can't afford a $1,000 emergency. So they're spending a lot of their money on fuel, on food, on very basic necessities. So those would actually probably decline in price because we get a lot of those obviously internally. If the dollar gets stronger, increases their purchasing product or purchasing ability. But, if they're going to buy an iPhone or a German manufactured car or, something shipped in from China, that would get more expensive, at least initially. And then if they can weave in, I think tariffs on their own would be a bad thing. But if you could put some corporate incentives, like a lower corporate tax rate, something that's to get companies to say, it makes sense now to come back to America for manufacturing. Even if you raise the tariffs, if companies are still figuring that it's going to be cheaper due to labor to stay in China or other countries, they're going to stay there. But if you can provide some tax incentives for them to come back and bring some of their manufacturing back, I think longer term, it is a good thing, both from jobs and then secondarily for national security. But in the short term, I would expect some inflationary to hit folks that are spending on more higher end manufacturing goods. Okay, that question, I think, Brian's question, Biden was for it, Trump was against it. I think he's talking about the digital currency. Yeah, I think, absolutely, I think that's true. I think more establishment DC types want that digital currency because it's going to give a little bit more control over the populace. So, whereas, I do think in this case, there's pretty clear that Trump would be more for economic freedom than the establishment DC folks. Okay. Well, great. Some good questions. I appreciate that. And we're going to continue talking about this because, the other big thing is Trump has an agenda, but he's also still got to get it through Congress. And you say, well, hey, they've got the House, they've got the Senate, but they don't have a 60 vote Senate. So the filibuster is always going to be in play. And so Democrats can still have a say in what goes on in economic policies. So there's definitely going to be some bartering taking place on that. So we'll see what eventually happens. Some things the president has more control over, such as the tariffs, but tax policy and those kind of things, that's definitely something that they have to get through. And the one that I'm really focused on is what's going to happen to the Trump tax cuts that happened back in 2017. They're due to expire at the end of 2025. So your initial instinct is, well, Trump got elected, they're going to continue, but they were due to expire because what they put on it initially was if our debt doesn't get affected by these tax cuts, which we'll look at the end of 25, then we'll continue with the lower tax rates. If the debt goes up, they're going to let the tax cuts expire. So it's pretty clear that our debt's gone up. So I'm not sure they're going to continue them. We'll see, though. A lot of people are thinking that they will, that they'll maybe make them permanent. I'm not sold on it. So we'll see. That's one of the big things I'm really going to watch, see what the chatter is. But that'll be a big thing because 26 will probably see every tax bracket goes up 3 to 4%. So that has a big impact. But you also have to say we have $2 trillion deficits per year. So if they don't get the budget in check, then we got to have some revenues somehow. So it's going to be an interesting thing to watch. So again, thank you for your time. Hope you have a great weekend, and we'll talk to you all later. Take care.